Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host here. This is going to be a short show today. It's a Friday, obviously, and we did have our Costco trade that we put on yesterday, and it worked out fine. I mean, we got our net credit that we wanted for the account, and that was a skip strike butterfly. But once again, that's to me just an alternative to a short call spread. Saying that you want the market to either stay where it's at or go down. But if it does drift higher, we're fine. And in this instance, Costco definitely went down. We're not well. It's not like an amazing amount on a percentage basis, but it's down 20 points after earnings today. So I want to jump right into it because I want to feed off of that trade, and I want to do a zero DTE butterfly in Costco. We found a couple other underlyings that we like to do them in. We were doing very well with our gold trade and our gold butterflies directional. And then on top of it, the other one that we've been kind of playing around with is United Healthcare. So it's 11 o'clock. Want to get the order in as soon as possible. So let's run to the Tradier Pro software. All right, so I guess I can start in the chains. Let's go back over to the chains. And here's where Costco's at. It's down 2% today, but that translates on a $1,000 stock into 20 points. So we're at 923.47. We're going to lean into the bearishness of Costco. We're going to put this trade on. We can do it. We're going to get pay almost what we pay in our SPX trades. Vol is still trading on these option contracts right around 40. We're on the zero DT. You want to make sure that that is correct. We can get this trade done for $3.65. So here's the trade. We're going to lean bearish. We're on the put side of things. We're in the zero. This has the rest of the day to trade. We're going to go a little bit in the money by the 930 strike put. Then we're going to go down to the 922.50 strike put, which is about where the stock is at right now. We're going to sell two of those. And then instead of going 7.5 points on the downside, like a regular butterfly would be, we're going to stop short. And we're going to stop at the 920. And we can get this done for $3.68. If we look now at the what if calculator, it's not a bad risk reward at all. If the market continues on down, you can make 160. And once again, keep your eyes over here. All right. So the market's right here, right now on our butterfly, right at our break-even point. Right. Break-even point would be this strike minus whatever we paid for it. We're going to say let's go 360, 370. We'll go 370. Okay. Because I got to get through the explanation. If I would work it at 365, but I wouldn't stay long. It'd be better if we put this trade on at 10:30. That's simple. But it's 11 o'clock, so time decay is kicking in. And if we go right to our middle strike is the 922.50. At that point, this trade is worth. You got a potential to double at that point, and it's going to be worth $7.50 on the trade. So not quite a double, but close. But if it lands anywhere between where it's at right now, all the way on down, we're profitable on this trade. We put it on for a few hours. Hopefully the bearishness continues. If it just stays where it's at, we're fine, but we do get hurt if the market bounces back and closes above 930. So that's going to be my alert, right? If the market's right now, so that's a 7-point move back, almost 1%. 10-point move would be 1% from the $1,000 range that it started at. And if we come all the way back, then at 930, I'm looking to get out at $930. And I'm just going to close it at that point, and I'll be at a loss. But I don't, once again, you put this trade on, you hope that it at least stays where it's at. If it drifts lower, well, then the trade's simple. If it drifts a little bit lower and we're about 2 o'clock or so, time decay should make us very profitable on this trade. We should be able to make at least a couple of dollars. Maximum that we could make on it would be 7 minus 370 or whatever we paid for it. But it's moving already. So this would be my trade. This is my paper trade for the day. I already put this trade on earlier as soon as the market opened. Right now, I still like the trade. It's that simple. Not meant to be a recommendation, right? It's a very speculative trade. The thing about doing zero DTE butterflies that are not in indexes is you got to close them because you could end up short Costco. You might get exercised on your long put, even though you're in control. If it finishes in the money on expiration, there's a possibility that your brokerage firm will exercise on your behalf and not close you out. Also, on top of it, the brokers might just close you anyways because, first of all, it's an expensive stock. So buying 1,000 share or buying 100 shares of a $923 stock at this point in time takes a chunk of change. So some brokerage firms may close you out. So it's important to show that you're active so that people can see that there's orders in. If I put the trade on right now, you're going to put in a limit order to close at, let's say, 355 at 550. You might go 6 because this is just in case I fall asleep and the market does hit my limit, then let's get out. So you'd go 550 or 6. That last dollar of premium is going to be hard to capture if it were trading for 750, which is the maximum. So maybe I put it in for 6. Let it sit there if you're watching it close. And if it does get close, you'll be happy to get out at 6. All right. If it goes all the way down to this level, it's going to be trading for around 5. Yep, exactly 5. Which is, how do I figure that out? We look at where the top strike is of our butterfly, which is 930. I guess I'll point over here a little easier to see on the screen. 930 minus the middle strike, which is 922.50. So that is 750. Then we take out the difference between this spread, which is 922.50 minus 920. So that's $2.50. So $7.50 minus $2.50 means $5. So if it trades south of this, it's going to be trading for $5. We pay $3.70 for it. I like the trade. I like even at 11 o'clock, it's still a solid trade. I kind of came up with the idea, honestly, talking on a different show that looking at the skip strike butterfly, which I really liked on Costco. If you could execute it, the problem with Costco is I left it in there at 40 cents when I put the trade in, and I eventually got executed. But I just left it. If I didn't get the trade, I didn't get the trade, is the way I approached it. So here it is. This is yesterday. This is Wednesday. For a second, we saw it at 40 cents, but Costco during the day was trading at 947.06. The expected, the one standard deviation move, I think it was just shy of 1,000. Like the fact that this was trading and it would have had to break through the $1,000 level in order to get to the point where we were at a max loss on the trade. When I took the screen grab, the midpoint of it was 25 cents. I did say to put it in at 40, and I actually took my own advice and just left it in there at 40 cents, and I eventually got filled. And my attitude on the trade was, I'll put this on. I need to get at least 40 cents on it with the type of risk that I have. And if it doesn't fill at 40 cents, I'm not going to chase it. And, it jumped around a little bit and got me filled at that level. And so I made the 40 cents on the trade. For every 1x2x1 butterfly that you put on, made 40 cents total on the trade. Max risk, though, was $1,000. If you look at it, because what we did was buy the long call. So this is the exact opposite of the trade that we have on. This is a skip strike butterfly, alternative to a short call spread, where on a short call spread, you'd be selling a call, buying a call as protection, hoping to make the premium, and that's the maximum you could make on the trade. That's the way the trade worked out. So you bought the 990, sold two of the 1000s, skipped the 1010, and then bought the 1020. So the risk from the 1010 to 1020, that shows your max risk on the trade of $1,000 minus the net credit of 40 cents. If it would have creeped up and at expiration started to close close to that $1,000 level, the maximum upside would have been also $1,000. So you had that type of risk. Now, in order to lose it all, you would have had to have double the expected move to get all the way up to the 1020 level. All right, I like that trade, but obviously you're not, the risk reward isn't as exciting. You do have the upside, but if you get that upside, it's got 1 day to live, but there's some stress involved too, because if it moves there instantly, you could still be down on the trade. You need time decay to happen throughout the day for this to work. But I like the underlying. I like what's on. All right. Thank you, Fresh Prince. The broker's not allowing me to place the order. Need some more winning trades to build up the cash. Are they not? Is the broker not treating it as a standard butterfly where it's the net debit paid? Because sometimes they will do that. Sometimes brokers will say this isn't a standard a standard butterfly. Okay, 1 second. There we go. Trying to just get that to move. Let's pull this back up. Sometimes brokers will say you can't. They'll charge you for a short call spread or short put spread, which would be $250. So they'll take out a requirement if it's not a standard butterfly, which is really annoying, honestly. But some brokers will do that, and so you go from 930 to 922, and then from 922 down to 9. Let me think. 915 right here. Okay, so I'm curious if you did it this way, and you went 9. You bought this. Sold two of these and then went down to this and bought this one. I don't know why I was struggling with that so much. That's just a standard butterfly. We'll send that to the what if calculator. And then the maximum risk is $2.35 as opposed to $3.70, what we put on. But then it's got to stay within the range. It's a much different trade to me. And I don't like it as much. You're still getting a premium time decay when you're doing the open wing, but you don't have to be so right about the direction. But this would be the alternative, and it's trading for $2.35. That would be your max risk. But if the market did continue on down and ended up closing below $912.50, I don't mind this trade. I just don't like it as much. Why? By doing the open wing and making it directional, you're still selling those option contracts that are at the money. You're still accomplishing your goal of trying to get high time decay from doing it. The downside is that you have to pay a little bit more for it, right? But now you only lose in one direction. So to me, it's a safe trade-off. I'm still accomplishing my goal of trying to get high time decay on options that only live for 1 day. But sometimes if you enter a trade like this, Fresh Prince, oh, okay. Says 0 DTE requires additional fund requirements. Yeah, Fresh Prince, you're right. They might. So let's put the last one in. The exposure to falling asleep and getting assigned. That's the issue. And that's what they sometimes will worry about in general, just with zero DTE trades. So they're making you say that you got to have a minimum dollar account in order to do. It doesn't necessarily even matter that it's a fancy trade, that it's 3 legs. It's the fact that there's only 1 day to expiration. And that's it. Yeah. So it's not my creativeness in my option strategy. All right. Which is weird because you can buy a 30-day option and ride it all the way to expiration, right? So it's always I don't know. It's weird. Each broker's different, but like, so what happens if I buy a 30-day option and now it's expiration Friday? Do they make you close it out because you got the expiration Friday? It's still the same situation. It's still the same issue in that scenario. All right, VIX. We put on our VIX trade last week and IWM. So those are the 2 trades. We'll look at those real quick. Let me pull up see where the actual VIX is at right now. We have the VIX down about 12 cents. Not too much going on. S&P 500 is up about 5. NASDAQ is down just a little. So we're teetering. We're still not in October. We got obviously September 26th. Gold is up a smidge. And did we get out of our gold trade? Do we have Anthony here? I don't remember if we actually closed our gold trade or not on the show. Did a lot of them. Still like that. I just like that underlying. It's just, it makes life easy. It's very liquid. And it's got some volatility, some predictability, which I always like to say is an oxymoron, right? But gold doesn't have the GLD isn't going to open up down 5%, right? Like cost goes down 2.3% in this instance. That just doesn't really happen in gold. It does trade overnight, so you do have some additional risks because of that. I got to admit, should make that a point. UNH we closed out. We did well on that. Oh, here's a gold trade. The 26th. So it expires today. I think we closed it. I guess I should look at the comments. But on gold, we use calls, so this would be profitable. And we looked over at this one on Wednesday. I might keep going back to the well on this. So it's up $2.69. What I'm talking about are the big gaps that you can't really trade out of. But gold is at a new all-time high then. It's very close to it. If it's not, let me go look at the chart. GLD, which is the SP is the spider that tracks gold. Yeah, look at that. Right? 447. What is the very top of this? Of course. Uh, 348.73. And we're at 347.45. The high today is 348.25. So we're at a new all-time high in gold. And look at, we did that little stutter step. It's like we got our steps in place. Up to here, plateaued, then we're here. Yeah, still trading it, still looking strong. You guys want to put one on? You want to put one on? Or would you rather wait till... See, the thing about gold is it would trade all weekend. I'd rather wait till Monday and put it on. I think we're going to do that. I think we'll wait. So we got a 0 DTE trade today. We're going to leave it at that. Fresh Prince couldn't get it executed because it is a 0 DTE trade. And any other questions? If you do, this is the last call for questions. I think we'll look at gold next week. We'll look at gold, and we'll do a couple. I'll try to change things up a little bit. UNH has done well, and I do know that we officially closed the paper trade. Let's pull in from here on down. 341. So we're still hanging out. And look at that. We're right at the top of that candle. Right there. So every time that it supports, that it can come down and it can hang out there, more and more chance for it to go back to this level at the 376 level. So I don't mind doing this on a bullish basis either. I prefer to get bearish going into October, but every once in a while, these are 1 week trades. So I don't mind looking at that. In IWM as well. Okay. And IWM is kind of flat. Not really doing too much today. Yeah, we're right here. This obviously, it likes, a lot of the indexes do like to ride the 20-day moving average. Like this was a scary point here. IWM, I don't remember exactly why, but it came right down to the 50-day moving average, hung out there, and then bounced. Now we're here. So if we break below the 20-day, then that could happen. In the IWM, Kurt, did we do a bear put spread, or did we look at the long straddle? Which one did you lean on? I don't mind either of them. I lean more bearish than bullish. But you got 30 days. Once again, next week should be an interesting week. Yeah, bear put spread. Okay. All right, everyone. That's it. That's where we're at. Fun week. Good week. Solid week as far as our paper trades were concerned. We'll be back on Monday, 11 a.m. Eastern time for the next edition of Options Guy TV. Hope to see you inside the Tradier Hub, hub.tradier.com. And if you haven't made a profile, please take the time to do so and support Tradier for putting all this great education and stuff together. They are the sponsors of this event. Open an account. That's simple. That's the best way that you can sponsor them, but at least share with friends and family. We'll see you this Monday next at 11 a.m. Eastern time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.